Good morning, everybody. Welcome to our last webinar for our affiliates for the year in our November webinar. So if you're not here with us live, that doesn't matter. I think most people are actually watching these recordings anyway. Well, I know for a fact that most people are watching these recordings. We've had some very good feedback about the timing being on 20 minutes because most of us are pretty busy and I don't tend to need more than that anyway. So what I thought I'd do today, given that this one will be the last one for the year, is we'll do a bit of a zoom out, and I want to do a zoom out, not just for the year just past, but I want to sort of map out a pattern, and I want to remind everyone about what our matrix formula is and how that's sort of mapped us to today, and then how that's looking for the year ahead. So let's go back to the GFC. So the GFC, as we know, there was a crash, in particular stock market crash, and the government implemented fiscal and monetary policy. So as far as the property market is concerned, their monetary policy through the RBA, they started reducing the interest rates. And from a fiscal policy point of view, they started actually introducing first home buyer grants, etc. So that therefore then very much stimulated the buying economy. And obviously that stimulated the construction industry, which is a very big industry for us in Australia. So one of the things that I've always taught for my whole career is that we don't predict. So we don't play the prediction game of trying to predict when interest rates are going to increase or decrease or flatten out, or what's going to happen to the market, or what's going to happen if a new government comes in, or etc. All we know is that the cycle will follow the cycle. So if we've got low interest rates, at some point they'll go up. If there's high interest rates, at some point they'll come down. So therefore we want a long-term strategy that actually incorporates having high interest rates and being successful and having a gain during high interest rates, as well as obviously in low interest rates. But the point is that when people start predicting, that's when it starts to get a little bit more of a gamble. And so when the GFC hit and interest rates came down and they were at record lows, I mean, we had 2% interest rates. No one could have predicted it was going to go for 13 years, 12 or 13 years. I mean, that's a very, very long period of time. So when people say that they know what's going to happen to the market, well, did they know that interest rates were going to go that low for 12, 13 years, and then it ends in a pandemic of which the government then overspends and increases inflation, which then increases the interest rates? I mean, I never predicted that. I don't think anyone predicted that. So to say that you've got a strategy based on prediction, that's garbage, right? No one actually can specifically predict things. We can have an idea, but it's much more of a solid foundational strategy to actually say, well, okay, we don't know when it's going to happen, but it's going to follow a cycle. Now, one of the frustrating things for me when the interest rates were very low for all that period of time is that everyone is all of a sudden a property investment expert. Well, it's pretty easy to be an expert when the cost of money is really low and the market is increasing the way it's increasing, all right? So it's almost hard to lose. But I was witnessing what a lot of people are doing and saying, yeah, well, it's great now, but you wait till interest rates go up and you'll realize what you've done. And so some people listened to that. Some people didn't listen and they went ahead anyway. Some people didn't do anything. Some people took my guidance and sort of, followed our matrix that I've been teaching sort of, since my mentor had taught me 30 odd years ago. And the reality is that interest rates started to come up and a lot of those people had to sell those properties in exit because they couldn't afford the cash flow because the property didn't provide a significant enough income to then be able to pay, obviously, the cost of the property with higher interest rates. So it wasn't a very solid strategy, especially if you're investing long term. Now, given that period of time, we were following our matrix in lots of areas around Australia that were going through high gentrification, but we needed to make sure they're going to have high income during times of high interest rates as well. And that's where obviously our matrix formula has always worked. Minimum yield of 4% at the time, very high gentrification and high population growth of young working people. And obviously those properties are brand new because the construction is trying to keep up with the demand. They've got to build the supply to keep up with the demand in those areas. House, townhouse, apartment, doesn't matter what it is. Now, when the COVID hit, and when we got to the stage where they closed international borders, now, if you remember, there was a lot of fear around during COVID. No one had been through a pandemic before, neither had we. But we held our nerve and we said, well, okay, let's still follow the formula. Where in Australia now we've got closed international borders, are there very heavy areas of gentrification? And really, there was only really one proper heavy gentrifying area, which was Southeast Queensland, because there was a lot of people from Melbourne and Sydney moving towards Southeast Queensland during that time where we had lockdowns, closed international borders, closed state borders, and people were saying, look, you know what, I'll do the 14-day quarantine and I'll move to Gold Coast or Sunshine Coast or Brisbane or wherever it is that they were going. And so that's what happens. So therefore, that's where we moved all of our sourcing of property activity. And so we found apartments in Maroochydore, we found houses in Redland Bay, we had townhouses in areas like Pimpama. And so all of our clients that invested during that time, I mean, literally their properties doubled in 3 years and subsequently got very, very high yields based on their purchase price. So a lot of those clients today, I mean, some of them are getting up to 10% yields, right, on their original purchase price. So everyone succeeded very, very well during that time. And that was during a very uncertain phase. But even so, we still followed the formula. We stuck to our guns. Now, then COVID came to a conclusion, the international borders opened, and we got a flood of migrants. The interest rates started to come up because the government overspent. They printed money to obviously cover for all that spending, and they do it through government bonds and electronically, etc. But the point is that creates massive amounts of inflation, and that happened around the world. So then we get penalised with increased interest rates to counteract the inflation, to curb our spending, and so as a result, we have higher interest rates. Now, what happened was when those, during COVID, the FIFO workers that were in WA, they couldn't come back over the border if they lived in the eastern states. So for their week off or their 2 weeks off or 10 days off or whatever it was, they would go quite often to Perth. So when COVID completed and borders all opened, a lot of those men in particular said to their families, look, I think we've got a better life here. Why don't you come over to Perth, bring the kids, and why don't we have a look at maybe moving to Perth? And so Perth then had this post-COVID migration that was actually going to Perth. And so there was migration locally. Now there was international migration in record numbers. So the majority of, was still going to Melbourne, but the point is there was a lot going to Perth, local migration going to Perth. And then Perth went through a massive growth spike, of which all of our clients were there because our matrix took us there. The formula followed us to Perth, and we've had clients that started investing in Perth in 2023, house and land, a 4-bedroom plus a 5th-bedroom house. Initially it was high 500s, then it got to low 600s. I just had a client revalue their property that bought at 630. They've just got a valuation coming at 875. So there's been an enormous amount of success from that. And so a lot of the wealth that was created with our clients in Southeast Queensland, they've taken that to Perth to invest in more properties. They've gained in Perth. And now we're looking for, obviously, for the next cycle, right? For the next cycle of growth. Now, in the meantime, what's happened around the country is that the rents peaked to their highest possible area that they could, or range in which they could get to. So when rents start getting to a third of people's income, you start reaching capacity of affordability. And so we've gone through a rental crisis, which you all know, and the rental crisis basically was propagated from the fact that when you have increasing interest rates, less people buy, more people rent. So that then drives rents up. We also had this, record numbers of migration, which then drives rental demand up, which drives rents up. And we also had supply issues post-COVID, so that we had a lack of supply. So, we basically have had a rental crisis. So that peaked once we actually start getting on average to a third of people's incomes, right, being rent. And in February this year, we started to see the interest rates, start to come down. So we've got a pattern of down, flat, down, flat. And now we've seen, recorded quarters this year of the last three, these last 2 quarters in particular. We're anticipating this, the 4th quarter as well, which will be 3 quarters in a row where there's been now net growth. And that's obviously directly related to the interest rates now coming down. In the meantime, though, what we've got maximised capacity and affordability in Southeast Queensland. We've got maximised capacity and affordability in WA and in Perth. And so as a result, there are opportunities definitely in those states still, and we still source those opportunities, but nothing like it was in Southeast Queensland 5 years ago, and nothing like it was in Perth 2 years ago. So where the opportunity now is predominantly in Melbourne, and that's for houses, townhouses, and apartments. And the main reason being is because we've got interest rates coming down. There's obviously an inflection now into the market. Melbourne's got the highest amount of migration that comes into Melbourne. Now that causes all sorts of problems. Like, obviously there's crime, and obviously there's all sorts of other problems that come with that migration. But that's what's happening. It's not something that I can physically change. We can't change that, but we can definitely use it as a strategy to make money from it. And, and the government's a basket case, right? So there's heaps of debt and all that sort of stuff, but it doesn't matter in terms of actually making money from the market, because it's, propagated by obviously huge amounts of migration. And also there's much greater affordability. And so that's why all of the experts, I use that term loosely, is that, the forecast is obviously Melbourne's going to have the greatest amount of growth for the fourth quarter of this year and actually going into next year. So that is definitely where we're seeing the greatest amount of opportunity, and the greatest amount of opportunity for houses. We're even getting houses that are not 2-part contracts. We're getting houses with 1-part contracts. Same with townhouses. There's 2 parts and 1-part contracts in townies, and there's very, very good apartment opportunities for a limited period of time. The problem with apartments in the foreseeable future is that the cost of construction has got to a stage now where it's very hard for a developer to make money out of a 1 or 2 bedroom apartment, and therefore I can't see for the next couple of years apartments being that popular in that space, because developers simply aren't going to be able to build them, right, and build them in an affordability range because of the cost of construction. The same cost of construction for a multi-story building, if they can build a luxury apartment, a 3-bedroom luxury apartments, then they'll obviously have much greater margin. They've got much area to make money from that. And that's obviously where the trend is moving forward. So unless you've got a very, very clever developer that has very clever ways of either buying the site and their construction methodologies with the builder and the way in which they market those developments, which there will always be those anomalies and will be all over it, it's not going to be as popular as now from a townhouse and house point of view. And now that we can get 1-part townies and 1-part house and land, that's making an enormous amount of difference moving forward. There's also builders that are incorporating technology now from the US, whereby they're incorporating AI, and that is allowing their cost of construction to reduce. And they're reducing it not necessarily in their materials, they're reducing it in their labor, because they can make much greater efficiency, and therefore we're seeing a shorter build with a more efficiency in terms of cost of construction. So AI and technology is really being incorporated, and that's come predominantly from the US, and we're starting to see that now come into play. So we can certainly foresee that, for the foreseeable future, at least until the end of next year, that most of the opportunities that are going to fit from a financial point of view and also from a city scoring point of view to maximize capital growth, maximize cash flow, minimize risk, is predominantly going to be coming from Melbourne markets. So that doesn't mean all of Melbourne. It doesn't mean that at all. It means predominantly in Melbourne growth corridors where the city score is actually high. So what we'll do is we'll have skeleton staff over the Christmas period in this industry. If you work in this industry, if you're a broker or someone like that, you'll know that a lot of this industry goes to sleep over that period. We will always have our agents working. We have always plenty of opportunities. We also have opportunities through our developers and our builders. One thing to note is that we always see price rises, especially in house and land and townhouses. All of the price lists get reviewed going into the new year. And so the new year in this industry tends to be after Australia Day. And so we'll have our first webinar for affiliates back next year in February. I can't see there being an enormous amount of activity and from a settlement point of view and all those sorts of things until after Australia Day. But we are still, all systems go with all of our agents moving through, working with clients. Clients tend to be very open, very relaxed. They have a lot more time and they have a lot more openness to us sitting down and walking them through our six-step process for us to be building their portfolios. So that's where we're at. Thank you very much for everyone's support, and thanks for working with us in 2025. It's been an amazing year for us. It's been a great year for me, personally. I've had an enormous amount of new clients, and in particular coming from affiliate partners. I've got a lot of new affiliate partners. They're very enthusiastic and been very impressed to see sort of the way in which we do business and seeing how that we actually manage that whole process to get results with our clients. So thank you again. Have a great break. Have a great Christmas. Have a great new year, and we'll see you all in February. All right. Thank you, everybody.